Let us go on to the contingent functions of money. Contingent functions of money. Under this, we have four side headings: basis of credit system, money facilitates distribution of national income, money helps to equalize marginal utilities and marginal productivities, and money increases productivity of capital. So under this, we have four side headings. I'm breaking the video into small bits because it will be easy for you to download it. I don't want to do it at a stretch. You will find it difficult to download, so I'm doing it in parts. Okay, so first we saw the first part, the primary function and the secondary. Now we are going to see the contingent functions. Under this, you have the basis of credit system. So money is the basis of the credit system. So business transactions can either happen through cash or credit. If you have cash, you give cash and buy. Otherwise, you say that you will pay it at a later date. That is only called as credit. So transaction can happen in two ways. One through cash and the other one is credit. So for example, a depositor can make use of checks only when there are sufficient funds in his account. So if I'm buying something in credit and if I'm giving a check, otherwise I buy something from the shop and if I give check, I just cannot give the check without no balance in my account. If I have enough balance, then only I can issue a check. Okay. So a customer or a depositor must have some amount in the bank. Okay. He has to deposit some money. The commercial banks, they create credit on the basis of adequate cash reserves. The commercial banks, they have cash reserves. Based on the cash reserves only, they can create credit. I hope you remember what I taught you in 11th standard when we studied about the functions of the commercial banks and the RBI in the 11th standard. I remember explaining this. How does the bank create credit? Suppose if a person X, he has got a lot of money with him, so he goes to the bank and he deposits in the bank. So when he deposits in the bank, suppose if he's going to deposit 1 lakh in the bank will say that you will get a rate of interest at 6%. Okay, there are various types of deposits: demand deposits, time deposits, okay, recurring deposits. So what do you mean by time deposit? It is for a particular time. So the Mr. X goes to the bank and he says that I want a time deposit for 2 years and he is depositing 1 lakh. So the bank is pretty sure that X is not going to come to the bank for another 2 years to get his money because there is a time period of 2 years. So the bank has promised to give him 6% rate of interest when they return that 1 lakh. Now, Mr. Y comes. Mr. Y is an entrepreneur. He is coming to the bank to take a loan. So immediately the bank knows that they have got this 1 lakh of Mr. X and it is not going to be used for another 2 years. So instead of idly keeping it the bank, the bank loans this 1 lakh to the borrower, Mr. Y. And they charge him a rate of interest of 10%. For X, they have to give 6%. But whereas when Y returns his 1 lakh loan, he has to return it 1 lakh plus 10% rate of interest. So what is the difference between the rate of interest for X and Y? It is 4%. X is getting 6%, whereas Y is paying 10%. So the bank has created 4%, okay, extra. This is only called as creation of credit. So this is how banks create credit. So this is possible only with the invention of money. Without money, they cannot do anything. So money acts as a basis of the credit system. This is the first point under contingent functions. So money acts as the basis of the credit system. So the commercial banks create credit on the basis of adequate cash reserves. So money is at the back of all credit. Next one, money facilitates distribution of national income. What do you mean by distribution? Distribution of income to the factors of production: land, labor, capital, organization. land, labor, capital, and organization. In those days, it was not possible to find out how much rent did the land get, or how much wages did the laborers get, because everything was paid for. They took commodities and they gave back commodities. So during the barter system, it was not able to find out the distribution of national income. But after the invention of money, money facilitated the distribution of national income. The task of distribution of national income was exceedingly complex under the barter system. Under the barter system, it was not easy to find out the distribution of national income. But after the invention of money, it has facilitated the distribution of income as rent, wages, interest, and profit. So money facilitates the distribution of national income. So after the invention of money only, you are able to find out how much is the land getting, how much is the laborer getting, how much are we paying for the capital. Okay, so the distribution of national income was facilitated by the invention of money. Next one, money helps to equalize marginal utilities and marginal productivity. What do you mean by equalizers? This also we have studied in 11th standard, the law of equimarginal utility. Suppose if a person wants to buy a product, okay, he is buying a commodity and he is paying money. So immediately he will try to find out whether the marginal utility of the commodity is equal to the marginal utility of money. Only then he will buy that commodity. In case, for example, you are taking an auto from here to Tank, from our school to Tank, you will know that you can pay 20 rupees for the service given by the auto driver, because it is going to cost only 20 rupees for a drive of nearly 1 kilometer from our school to Tank. You can pay 20 rupees. In case the auto driver asks you to pay 100 rupees, நான் உன்னை போய் டேங்க்ல விடுறோமா, எனக்கு 100 ரூபாய் தான்னு சொன்னா, will you give that 100 rupees? You will not give, because you will try to equalize the marginal utility of the service given by the auto driver and the marginal utility of money. நான் கொடுக்குற பணமும் எனக்கு கிடைக்கிற யூட்டிலிட்டி, ஆட்டோல இருந்து கிடைக்கக்கூடிய யூட்டிலிட்டியும் சேமா இருந்தா தான் you will part with the money. So only with the invention of money you are able to equalize the marginal utility of the service, of the product or the commodity and the marginal utility of money. நீ வாங்க போற ப்ராடக்ட்டோ நீ கொடுக்க போற காசுனுடைய யூட்டிலிட்டியோ சமமா இருந்தாதான் நீ என்ன பண்ணுவ, காசை கொடுத்து அந்த பொருளை வாங்குவ. யூட்டிலிட்டி, நீ கொடுக்குற காசுனுடைய யூட்டிலிட்டி ஜாஸ்தி, பொருளுடைய யூட்டிலிட்டி கம்மினா you will not buy this. So this is what we studied last year in the equimarginal utility. The cost of apple is 5 rupees and the marginal utility of money is also 5 na vaangirva. If not, you will not buy. So only with the invention of money it helps you to equalize the marginal utility. Similarly, marginal productivity, how much does the factor of income contribute? If the land is contributing more, you will give more money. If the land is contributing, if the marginal utility of land is less, you will give less rent. Similarly, if the marginal utility of labor is more, you will give him more money. If the marginal utility of labor is less, you will give him less money. So you will try to equalize the marginal productivity and the marginal utility of money. So money helps to equalize marginal utility and marginal productivity. Next one, money increases productivity of capital. Money increases the productivity of capital. How? Money is the most liquid form of capital. Liquid means what? Easily convertible. Assets which can be easily converted into money only is called as liquid asset. So the most liquid form of your asset is money. In other words, the capital in the form of money can be put to any use. If you have money, if you have lots of money, you can buy either a theater, or you can shoot a movie, or you can buy a mall, or you can run a school. So money can be used for several uses. You can use this form of capital can be put to any uses. This form of capital, okay, which form? Money. Money in the form of capital can be put to any use. So it is on account of this liquidity of money that capital can be transferred from the less productive to the more productive uses. So in case you are doing a business and the business is less productive and you find some other business which is more productive. So what do? You transfer the money from the less productive business toward the more productive business. So money increases the productivity of capital. Are you able to understand? Money increases the productivity of capital. Money is the most liquid form of capital, and in other words, capital in the form of money can be put to any use. So it is on account of this liquidity of money that capital can be transferred from the less productive to the more productive uses. So these are all the contingent functions of money. Basis of credit system: money facilitates distribution of national income. Money helps to equalize marginal utilities and marginal productivity. And lastly, money increases productivity of capital.